Okay. Let's just unpack this right out of the gate.
Yeah.
Because it is, I mean, it's the story dominating every financial news feed right now.
Yeah, it really is
You
everywhere.
have this high-flying private bank, a massive pile of government money, and a fraud that seemingly came out of absolutely nowhere to just, wipe out an entire quarter's worth of profit.
It's the exact kind of headline that keeps risk managers awake at night. We are talking about the IDFC First Bank case. A fraud estimated at 590 crore rupees, all discovered at their Chandigarh branch.
Exactly. And if you look at the stock charts, the market has absolutely punished them for it. Shares were tanking nearly 20% at one point. But here's the thing. We're not here today to just read you the headlines. We have a job to do.
Right. For this deep dive, we are effectively putting on our senior forensic financial analyst hats.
Yep.
We are not just gawking at the scandal, we're looking at the fundamentals. We've pulled the RBI statements, the emergency investor call transcript from February 23rd, 2026, the FIR details from the Haryana police, and of course the bank's latest annual report.
And our mission for you is simple but really critical. We need to move past the panic and generate a clear investor-grade recommendation. By the end of this conversation, we want to answer the big question: is this stock a buy, a hold, or a sell?
To do that, we have structured our analysis into three main parts. First, the incident breakdown, what actually happened on the ground. Second, the financial hit, just how bad the damage really is. And finally, the verdict. Is the bank fundamentally broken, or is this just a very expensive stumble?
So let's jump straight into Section 1, the incident breakdown. Because I have to admit, when I first read 590 crore fraud, my mind went straight to, complex cyber hacks or some algorithmic glitch in the trading software. But that's not what happened here, is it?
Not even close. And I think that is what is so fascinating and frankly so frustrating about this entire case. This wasn't some highly sophisticated cyber attack. This was effectively the oldest trick in the book.
Right.
We're talking about forged physical checks.
Physical checks. I mean, in 2026, I don't think I have written a physical check in maybe 5 or 6 years.
Precisely. It's almost retro. So here's the timeline. The fraud surfaced when a department of the Haryana government, this was specifically connected to the urban local bodies and the Panchayat department, they tried to close an account or just transfer some funds.
Okay.
So they looked at their internal records, they looked at the bank balance, and they realized the numbers did not match up at all.
And we're not talking about a small rounding error or a delayed clearing.
No, we're talking about a massive gaping discrepancy. The bank did an immediate reconciliation and found about 490 crore rupees just missing, plus another 100 crore they estimated internally as, potential additional exposure.
Wow.
Which is what gives us that headline number of approximately 590 crore.
So how do you even move that much money with paper checks without anyone noticing? That is just, it boggles the mind.
Well, this is where the forensic part of our job really comes into play.
Yeah.
The bank's CEO, V. Vaidyanathan, was very clear on the emergency investor call. This wasn't a failure of the system's technical design. It was a failure of the people running the system.
The human element.
Right. It appears to be a textbook case of collusion. You had employees at the Chandigarh branch, 4 of whom have already been suspended, by the way, allegedly working in cahoots with external third parties.
And reading through the police reports, it adds some really serious color to this. I saw mentions of an untraceable suspect who might have actually fled the country.
That's correct. The Haryana Police and the State Vigilance Bureau have filed an FIR under the Prevention of Corruption Act. They are looking at the bank officials, obviously, but they are also scanning 4 IAS officers for their supervisory roles.
Okay.
Because the money was transferred to beneficiary accounts completely outside the bank, and now investigators are just scrambling to trace where those funds actually landed.
What a mess. But this actually leads us perfectly into Section 2, our root cause analysis. Because you mentioned the word collusion. Why is that specific distinction so important for investors to understand?
Because it is the difference between a broken lock and a security guard stealing your key.
Right. Great analogy.
Banks operate on what's called a maker-checker policy. One person inputs a transaction, that's the maker, and another completely separate person authorizes it, the checker. It is a fundamental internal control.
But if the maker and the checker decide to, say, grab coffee together and agree to steal the money?
Exactly. Then the system just sees a valid, fully authorized transaction. The computer thinks everything is totally fine because the humans told it everything is fine.
And the irony here is just palpable. IDFC First Bank is widely known as a tech-first bank. They have incredible digital controls. But this fraud exploited the analog loophole.
Yes. Physical paper leaves a much, much slower trail than digital footprints. By the time the paper is finally reconciled by the back office, the money is long gone.
It feels like we have seen this movie before in the Indian banking sector, though. How does this compare to, say, the Nirav Modi PNB scandal or the PNC bank crisis a few years back?
That is crucial context for anyone looking at the stock. The PNB fraud was a fundamental failure to integrate two systems, SWIFT and the core banking system. It was a massive technological gap that allowed unauthorized guarantees to just flow through.
Right, the system blindness.
And PNC Bank was about hiding accounts entirely from the RBI to mask bad loans to a single real estate developer. That was top-down corruption.
Got it.
This IDFC case is very different. It is strictly branch-level misconduct. It is not a failure of the central banking software. It is a failure of specific humans in a specific building in Chandigarh.
Which, I suppose, is a lot better than a system-wide structural failure. But it still hurts. Let's talk about exactly how much it hurts in Section 3, the financial impact assessment.
Right, let's do the math for your portfolio. The total fraud is 590 crore. Now, typically, you would hope insurance covers a big chunk of this.
You would assume so.
But in the investor call, management revealed that their employee dishonesty policy only covers about 35 crore rupees.
Ouch. So the bank is just eating almost the entire loss directly.
They are taking the hit. To put that in perspective, in Q3, the bank made a net profit of about 503 crore. So this single fraud essentially wipes out more than a full quarter of their earnings. For the upcoming Q4 results, the bottom line is going to look incredibly ugly.
That sounds absolutely disastrous on the surface.
It looks terrible on the P&L statement, yes. But, and here is where the senior analyst view really matters. You have to look at the balance sheet. The bank actually has a net worth of over 46,000 crore rupees.
Okay, that changes the scale.
Right. A 590 crore loss is painful, absolutely. But it represents only about 1.3% of their total net worth.
So to put it bluntly, it's a flesh wound. It's not a fatal blow.
Financially speaking, yes. The bank remains extremely well capitalized. They aren't going to run out of money or default because of this. They've asked other banks to freeze the beneficiary accounts, what's technically called marking a lien, but honestly, we shouldn't bank on getting that money back anytime soon.
Yeah, recoveries in India are notoriously slow.
Very slow.
Okay, so the bank isn't going bankrupt. But if I look at the stock market reaction, you'd think the sky was completely falling. That brings us to Section 4, the market and institutional reaction. The stock dropped nearly 20%. Is the market just overreacting?
It is a panic reaction, definitely, but it is rooted in something very real, and that is the governance premium.
Explain that a bit.
Investors gladly pay a higher price of premium for banks they trust explicitly. When a fraud of this size happens, even if it's financially manageable on the balance sheet, it violently erodes that trust. The market is effectively repricing the stock in real time to say, we don't trust your internal controls as much as we did yesterday.
And it's not just the stock market reacting. The real-world business consequences are happening fast. The Haryana government pulled the plug almost immediately, didn't they?
They did, and this is honestly the most damaging immediate fallout from a business perspective. The Haryana government de-empaneled IDFC First Bank, and interestingly, AU Small Finance Bank was caught in the crossfire too from their list of authorized banks. They're actively moving their deposits out. See, that scares me way more than a one-time 590 crore loss. If you lose government business, you lose access to those cheap, sticky bulk deposits.
It is a highly valid concern. However, we do have to remember the sheer scale of the bank. They have total deposits of over 2.5 lakh crore.
Right.
The Haryana government deposits are significant, sure, but they aren't the vast majority of the franchise. The real risk here is what we call reputational contagion. Will other state governments follow suit just to be safe?
That's the big question. Which brings us to Section 5, regulatory and legal risk. Because usually, when a bank stumbles this publicly, the RBI steps in with a sledgehammer. What is the regulator saying right now?
This is actually the major silver lining for the bulls. The RBI governor, Sanjay Malhotra, explicitly stated on record that there is, quote, no systemic issue.
That is huge.
It is a very powerful phrase in central banking. It deliberately differentiates the situation from a yes bank or a PMC bank collapse scenario. He's effectively telling the market this is a crime scene, not a structural collapse. And the bank hasn't just been sitting on its hands. They brought in the heavy hitters for the cleanup.
Correct. They immediately appointed KPMG for an independent forensic audit. That timeline is tight too, about 4 to 5 weeks. Investors are going to be holding their breath for that report.
So if KPMG comes back and says, yep, it's just 590 core, the stock probably stabilizes.
Exactly. But if they dig in and find more rot, we are in serious trouble.
Well, let's debate that rot for a second. Moving to Section 6, systemic versus isolated risk. We are basically debating the rotten apple versus the rotten tree. You mentioned the RBI thinks it's isolated. What is the actual hard evidence for that?
The evidence for isolation is actually quite strong. First, it is physically confined to one location, the Chandigarh branch. Second, it involves one specific client group, the Haryana Government entities.
And third,
And most importantly, no other branches have reported similar reconciliation issues, even though the news has been out and every branch manager in the country is double-checking their books right now.
so the logic is, if the controls were fundamentally broken everywhere, we would have seen smoke billowing from other branches by now.
Exactly. Fraud is a lot like water. It finds the crack. If the crack was system-wide, we'd see leaks springing up everywhere. Here, the leak is very intensely localized.
Okay, so let's look away from the leak for a moment. Section 7, our business fundamentals check. If we try to ignore the fraud, which I know is hard to do when looking at the ticker, how is the actual core business running?
The underlying engine is actually humming along beautifully. Based on the annual report and the investor call, their core operating profit is generating over 2%.
That's solid.
Their CASA ratio, which is the percentage of cheap current and savings accounts, is at a very healthy 46.9%. And crucially, their lending book is heavily retail-focused.
Meaning they aren't making huge bets on single entities.
Right. They aren't lending billions to risky corporate infrastructure projects anymore. They are lending to everyday individuals for homes and consumption. That is a much, much safer bet in the long run.
And I have to give some credit to the CEO here, V. Vidyanathan. The news broke, and he was on a call with investors almost immediately. It was a Sunday or Monday morning, and he wasn't hiding behind a bland PR statement.
Transparency is a double-edged sword, but in a crisis like this, it is really the only shield you have. By facing the music so quickly, he likely prevented the stock from falling 40% instead of 20%. He framed the narrative before the rumors could completely take over the market.
All right, let's get to the real meat of this for the listener. Section 8, the bull versus bear case. I'll play the bear. I'm the skeptical investor looking at my portfolio bleeding.
Go for it. Let's hear it.
Okay, I'm selling. I'm saying where there is smoke, there's fire. You lost 590 crore to a paper check scam. You lost the Haryana government business. Recoveries in Indian banking frauds are basically a myth. You're never seeing that money again. And your earnings for the next quarter are going to be zero. Why on earth should I stay?
That is a very strong logical case. Now, let me give you the bull case, the buy argument.
Give it to me.
The stock is down 20%, but the actual loss to the net worth is only 1.3%. The market has essentially overreacted by a factor of 15. The core retail business, the millions of people depositing salaries and taking out home loans, they do not care about the Haryana government's checks.
That's fair.
Plus, the RBI has given a clean shit on systemic risk. So this is a classic buy-the-dip opportunity where you can buy a fundamentally good asset at an artificially distressed price.
It's a compelling counter-argument, I'll admit. But as an investor, you can't just flip a coin based on two good arguments. We promised you a framework. So let's hit Section 9, the investor decision framework. What are the specific actionable things we need to watch in the next 30 days?
I have 3 critical things on my checklist. Number 1, the KPMG report. Does the fraud number stay at 590 crore? If it creeps up to 700 or 800 crore, the trust completely evaporates. It absolutely needs to stay capped.
Okay, what is number 2?
The Q4 results. But, and this is key, don't look at the net profit. That bottom line will be completely wiped out by the provisioning for the fraud. You need to look at the pre-provisioning operating profit.
Why that metric specifically?
Because it tells you if the core business is effectively making money before it pays the bill for the crime. If that operating number grows, the main engine is still intact.
Makes sense.
And number 3.
Contagion. Watch the news tickers for other state governments. If Punjab or Rajasthan starts pulling their money out of private banks, then the bear case wins. If Haryana is the only one to react this way, the bull case wins.
So we have weighed the evidence, we have looked at the scene of the crime, the balance sheet, and the broader market. It is time for Section 10, the final verdict. What is the ultimate call for you, the listener?
If you are a short-term trader, my explicit advice is avoid. The stock is currently in the news cycle penalty box. Every small rumor on social media will violently swing the price. It's just too volatile for a short-term play.
And for the long-term investor, the person looking 3 to 5 years down the road. For them, the official rating is hold or accumulate.
Okay.
The franchise is fundamentally strong. The management has proven credible under fire. The fraud is less than 2% of their total value, but the price drop is much, much larger. If the KPMG audit confirms this is an isolated incident, this entry point will look like a massive bargain in 2 years.
So what is your overall confidence level in that thesis?
I'd say medium-high. It is strictly contingent on that KPMG audit finding no further rot. But the underlying fundamentals strongly suggest resilience.
There you have it. A really painful stumble. A glaring failure of human controls at the branch level, but likely not a fatal blow to the institution as a whole.
And before we wrap this up, there is one thought that really stuck with me while I was reviewing all these documents last night.
What's that?
We spend billions of dollars on cybersecurity. We have biometric firewalls, AI fraud detection, multi-factor authentication. But this entire 590 crore mess happened because of physical paper checks and a forged signature. It really begs the question, in a world totally obsessed with guarding the digital cloud, did we forget to put a lock on the front door to stop a guy walking out with a piece of paper?
That is a genuinely terrifying thought to leave on. Look, if you want to see the full investor checklist we just discussed, definitely check the show notes. We will be tracking that KPMG report the second it drops.
Absolutely. Stay vigilant out there.
Thanks for listening to this deep dive. We'll catch you on the next one.